Hi, welcome to Numeric's video blog. I'm your host, Jim Jockel. Joining me today, Vice President of Client Solutions Group here at Numerics is Udi Silva. Udi, welcome.
Thank you. Good morning, Jim.
As bank commodity desks have suffered many blows over the past year, whether it's losing talent to hedge funds or seeing closures of actual particular hedge funds, Risk.net came out with a very interesting article focusing on airlines moving away from hedging, specifically around oil. So I want to jump into a lot of topics today, but why don't we start there, Udi, and perhaps you can give me a little bit of summary of what's going on as it relates to the departure of airlines in terms of their hedging strategy.
Right, Jim. So just with the starter. So indeed, banks have suffered a drop in business and losses. Said the same applies for hedge funds, and we've recently heard of a few hedge funds, closing down, specifically in the commodity space due to the let's say unprecedented move in the market. And the third type of player is, of course, hedgers. In our example, airlines, and where we see also that at least the American airlines have reduced their hedging programs, if not stop them completely. So yeah, so these three factors actually play in, and of course we've seen this massive move in the market.
Well, one of the elements is has been the lack of volatility around oil prices. I mean, obviously, oil prices were high going into 2008, but relatively stable. I mean, how much is that playing into the U.S. airlines' decisions as it relates to moving their hedging strategies?
That's a great question, because actually until recently, in over let's say up to a few months ago, over the last 18 to 24 months, yes, commodity prices were, especially energy prices were high, but we're stuck in a range. So basically, when you feel comfortable and when security prices trade in range, typically the implied volatility comes down, and you don't feel really the urge to hedge. Now, if you are a consumer of energy, and of course airlines are huge consumers of energy, a typical large American airline would consume at least, or the hedging, the budget for fuel, jet fuel would be maybe $5 to $10 billion, depending on the size of the company. You feel comfortable. Now, specifically American Airlines, if you take the CEO of American Airlines, his approach was that he has a natural hedge. If prices come off, then he's good for not hedging. And if prices come up, he claims that prices go up because there's more demand. And if there's more demand, he has a natural hedge by actually applying his pricing power and raising airline tickets. And indeed, in Europe, this does not exist, because Europe did not go through the same consolidation as the American airline industry, where you have practically 4 to 5 large groups. In Europe, the market is much more fragmented, and the pricing power doesn't really exist. It also has to do with different economic cycles in Europe as opposed to America.
So it's almost the same Walmart effect, if you will, as it relates to price elasticity and oil and demand.
Absolutely.
So one of the things that I found really interesting that I didn't realize was with any shift in the marketplace, you have new entrants, and two new entrants that have registered as swap dealers under Dodd-Frank were BP and Shell, and we're starting to see others emerge in terms of offering services. Tell us a little bit about that shift and balance.
So I think we kind of touched it in other video blogs that we conducted together. Again, the regulatory arbitrage. So the cost of doing business in the derivative space now in our where we're discussing really in commodities, the cost for banks is much higher than for corporates. Now, if you look at a company like Shell or like BP or RW in Germany or GDF in France, this is because they are long the underlying assets, which is really petrol or the crude energy, if you like. It's really a vertical integration for them. It's almost a natural hedge to deal in this market. The other thing is that since banks have lost the appetite, plus the increasing cost, regulatory cost, the fine traders are actually moving from the sell side to the buy side. So they bring with them the know-how and the knowledge of managing a derivatives book. So in a sense, it's much more natural for those large energy companies to manage a derivatives book, and that's what we see.
Well, also just thinking about the physical storage of that, we've seen, I think it was Goldman and Morgan Stanley also remove elements of their commodities businesses as not having to manage the physical storage of the commodities itself. Um, so as we go forward, I mean, looking ahead into Europe, what do we see in terms of these new entrants and the robustness of hedging? And how much of dealing with accounting rules are the airlines trying to manage as it relates to this move away from derivatives?
Yeah, so the consumption of or the capital that needs to be set aside when you trade forwards, simple forwards, or even buy future contracts, as opposed to buying an Asian option, is lower. Therefore, the appetite for these consumers to actually hedge is lower. Now, when the market is dropping so dramatically, and there is a real geopolitical shift in the sense that America, the U.S. is now becoming a net exporter of oil and energetically independent. So that means that there is much more, with the fracking, there's much more supply of oil in the world. And therefore, the urge of, or the story that we heard up to, like, let's say 2 years ago about shortage of energy has actually turned upside down. So therefore, the appetite to hedging is much more limited. And when people hedge, they tend to do that, with more vanilla products. And the third thing is that in some cases, corporates look at the credit, if you like, the counterparty risk. So I remember from my days as a trader that we used to look at corporates, but now corporates look at banks. And in some cases, some strong, solid energy companies are perceived to be, are ranked higher in terms of credit worthiness as opposed to banks. That's another thing. So I'd rather trade with a company that has the know-how, that has the underlying asset, and is perceived to be stronger from a credit perspective. So again, this is something that drives business away from banks.
Well, I think one of the things, and hopefully lessons learned over the past few years, is better transparency, especially if you're having more and more companies, regardless of credit quality, providing that type of derivative type product. When we look at Enron with the rating triggers and as a particular counterparty, with a lack of transparency, which arguably as an energy trading company, not as a power company, got into some particular problems. So hopefully with the new regulation, there'll be much more transparency as it relates to these activities and offerings that different companies are now coming to market with.
Yeah, just as you mentioned, like when we have those corporates, which we mentioned earlier, a register is set. It's really a paradigm shift where market making will not come just from the sell side, and it's pretty much taking away banks.
Well, Udi, I want to thank you so much for joining us today. Obviously, this is going to be something we're going to watch, especially as we get to the end of year totals of derivative trading. Want to get your insight as to the overall shift of issuance and notional outstanding, and we're continuing to see some declines as it relates to overall notional within the OTC market. So thank you very much, and I look forward to the opportunity of speaking again.
Thank you very much for your time in organizing this, Jim.
Of course. And of course, we want to talk about the topics that you want to talk about. So please feel free to follow us on Twitter at NX Analytics, or stay up to date with all of our ongoing information and thought leadership pieces into the marketplace on LinkedIn or on marriage.com. We'll see you next time, Udi.
Thank you.